In this session, I'm going to talk about an article which heavily highlights on best practices in risk management that we have learned from the recent financial crisis. So, wherein I would be talking about what is the link which has been identified between the risk measurement measures that are followed at the firm level and how do they really impact the entire systemic level. Very interesting discussion that has been covered as a part of the article. Right, the firm focused risk measurements, how do they really backfire the systemic concerns? And what are the different kinds of lessons that the recent global financial crisis 2007-9 has really taught us? Then we would be discussing a little bit regarding the different regimes for volatility, how the volatility has been behaving, and because of this, what are the implications of using value at risk and other measures for capital adequacy purposes and determination of the capital requirements, etc. And what are the implications for the risk management best practices when I'm looking at all these different volatility regimes. So this is what is the context of the article. Now, the best practices, we are talking about the best practices and the new challenges. What once were considered as the best practices, how did they pose as a challenge? From the perspective of, we are looking at the internal risk measurement part and the kind of a data that is supporting it. So here the focus is purely the internal risk measurement. What are the different best practices? What are the new challenges with respect to the internal risk measurement and the data that is typically used for measuring this risk? So here typically if you look at the flow, I'll be talking about the major trends and developments that are brought out by the financial crisis. What are the different lessons that the financial crisis has really taught us? What are the things that have really changed in the financial markets after the financial crisis? So that's one important part. And the other important area is how to really make risk measurement pro-cyclically, whereas risk management can happen counter-cyclically. So we'll talk about it. It has to be highly sensitive to risk. Risk measurement should be highly sensitive to risk, but it should not produce the risk management that amplifies the risk. Right? I should measure it, but when it comes to the management part, the steps that I am taking should be to reduce the risk, but they should not be targeted towards increasing the risk. We'll see some instances where the steps that we have taken for reducing the risk in turn backfired and resulted in amplifying the risk as well. So that's an important area that we are going to discuss here. But of course, few things we have to keep in mind which are universally applicable. Whenever we are using the word risk measurement, we can't take out the governance aspect out of it. It is very much embedded, and every company should create a kind of a culture which is responsive to risk measurement. Even when you are getting a kind of a worst outcome out of your data, but the culture of the organization should be responsive to risk measurement. If that culture is not there, whatever is the data, whatever is the goodness of the data, whatever is the level of analysis you perform, you cannot improve the risk management aspects in a company. And we need to understand that if at all the risk measurement is integrated into the performance measures of the company, then governance becomes even more an important aspect, because measures are going to create incentives which will force the employees to really tweak the system to take an undue advantage out of it. So we need to understand the fact that the risk measurement is highly connected with risk governance. But and at the same time, because of this, there is also a possibility that the risk measurement needs to be looked at from the macro level, where the entire system can get affected by the actions that are being taken by one or more firms. So that's one more dimension where the focus needs to be driven on. Nowadays, at least, some kind of an improvement that the risk function is nowhere a part of the line function. It is coming out as independent reporting line with different track of reporting altogether, and it is enjoying a greater economy and autonomy compared to what it used to be in the past. But the challenge still lies: how do I really ensure that the risk oversight plays a strategic role, not just an audit kind of a role, not just a compliance kind of a function? It has to play a strategic role in terms of improving the overall productivity and productivity and the top line and the bottom line of the company as well. Now, that's where we'll move, trying to understand how does the different risk measurement activities that are taken up at the firm level, risk measurement activities that are taken at the firm level, how do they really impact the entire system? Okay, some of the different links, some of the different sources, risk can spread from one firm to another. Direct interconnections, A and B lend to each other. A defaults, probably B is not getting the funds on time, B may also default. So that's a direct interconnection where two firms, because of the different kinds of trades that are existing between them, a default from one is going to spread to the other. That's the first instance. Then, even if they don't have a direct connection, typically all the financial institutions have a lot of things in common. The economic environment in which they work is common. The regulatory environment in which they are operating is common. So, which means there are so many common factors between the various financial institutions. So, the risks that they are exposed to, they are not independent of each other. There is a high level of correlation existing between them, and the losses can spread from one to the other because of that common factors like market prices. A market price increase, inflation in the economy is going to impact all the firms in some way or the other. Though they may not be directly dealing with each other, a common factor regarding the economy is going to impact them in a big way, right? So that could be another link where one company's specific actions could be carried forward to the entire system. The interesting aspect, however, is this particular statement. A risk mitigation action, I am implementing a risk mitigation plan. When I alone implement it, when my firm alone implements it, it's an effective and excellent plan. But if all the firms implement the same solution, the plan becomes ineffective, right? So every risk management solution, if I look at it from a firm-wise perspective, it looks excellent. But if the same solution is implemented by all the firms in the economy, then there is no benefit that is coming out of that solution. That is how one single solution that is implemented at a firm level would be carried to the entire system, financial system level. That is where the firm should pay attention to the systemic risk, and the regulator at any point in time, they need to know what is the mechanism the firm is using to measure the risk and manage the risk, because even a very good risk management plan of one single firm, if it is replicated by others, probably the firm might find it as a best practice, but if it is replicated by the others, then the value that that solution is developed is typically going down. Very interesting aspect that has been observed as a part of this article. Now, a quicker look at the various lessons or various developments that have come up post the financial crisis in the entire financial market. Just giving you a different summary. Now, while measuring the risk, the point that came into a picture is take a long-term perspective on the risk. Both when you are taking the historical data for some kind of measurements, or even when you are developing the models for the future predictions, don't take a short-term perspective, take a longer-term perspective, historical and looking forward. Look at the volatility regimes. So how the volatility is changing with time. It has been observed that for different kinds of securities and indices, at different points in time, the volatility patterns were different. So, understanding the volatility regimes on the risk measurement, what kind of impact they have on the risk measurement. Why is VAR a big failure? Or how can VAR have the limitations? So, look at it from the volatility regime perspective. And what we are saying is this kind of volatility regimes can be looked at only if I have the data of a very long term taken into consideration. Because the volatility may not fluctuate that heavily when I am taking a short term data. So that's the reason the perspective should be more and more long term. And understanding this will really help in terms of building stress scenarios. The extremities I can really incorporate into my model and then build different stress scenarios out of it. So that's the reason we can create the stress scenarios only if I look at from a long-term perspective. That's the reason one important perspective that came post the financial crisis is not a short-term outlook. We are looking at a very long-term perspective on the risk. Then the next thing is there's a lot of attention that has come towards counterparty risk. Probably there's a lot of focus, right? Lot of research going on understanding the counterparty risk in depth. There is a notion that came up as a part of the crisis, too interconnected to fail, to macroprudential concerns. So they are so interconnected that they can't fail. That was the notion, too big to fail, too interconnected to fail. They can't fail because they have too much of interconnections and everyone else will bail them out. So that kind of notion has come out, which means there is a very clear need that the counterparties need to be evaluated, assessed to a large extent. We have seen a lot of stories, collapse of AIG, several monoline insurance companies. What was the outcome of because of their collapse? The lesson that I have learned, or we all have learned, is high credit ratings cannot substitute for due diligence. So that is where Dodd-Frank Act has gone even one more step further and said credit ratings cannot be used by the regulators as a basis. So The high credit ratings, AAA credit ratings cannot be substituted for due diligence and careful monitoring of the counterparties. So one important point that has come out after the crisis. And from the failures of Lehman Brothers and Bear Stearns, etc., what is the kind of a lesson? Counterparty risk has to be reassessed. In prime brokerage and all the OTC derivative contracts, I have to keep reassessing the counterparty risk. And probably during that crisis time, 2007 and 2008, we have seen the instances where the LIBOR OIS spread has gone drastically higher. And this is a market measure of interbank counterparty risk. So there is a lot of focus in trying to understand this spread. And some of the interesting things that came out, collateral in the derivatives. Usage of collateral in the OTC derivatives has really increased. There is a study which says 80% of the OTC derivatives between the major dealers in 2010 are collateralized, whereas that number used to be just around 55% in 2000, which is a clear indicator that the usage of collateral in the derivatives market has increased quite drastically. And there is a lot of pressure on usage of portfolio compression services, which were using multilateral netting of OTC derivatives. Though it's an extra cost, there is a lot of focus towards the usage of portfolio compression services because the benefits that are coming out of it is profound. Then the Dodd-Frank Act, which was clearly highlighting the fact that most of the derivatives should be moved from the OTC trading, which is the bilateral kind of a clearing mechanism, to a central clearing mechanism so that a lot of transparency to the counterparty exposures can be brought out. So the focus on counterparty risk has been tremendously higher. Addressing the counterparty risk has been tremendously higher as an outshoot of the financial crisis, right? Now, a few more interesting lessons that came out of the crisis, or a few more developments that came out of the crisis. The new focus came up on funding liquidity. We know that the limits of liquidity mismatches have been pushed up. Otherwise, all these banks and financial institutions, they were having very short-term sources of funding where the focus was on overnight repo funding, security lendings, which are very short-term sources of finance. They have used to fund the investments in risky assets which are very illiquid and long dated. So probably there's a lot of liquidity mismatch. And now we see that this kind of liquidity mismatches have resulted in having higher levels of capital. Now there is a tighter control on the repo market as a development out of the crisis. And there are new rules for the money market funds where their role is constrained primarily as a source of short-term financing only. And as a part of the Basel III, the liquidity buffers have been set for the banks. And the fundamental that is a very important aspect is for the different OTC transactions, there is a possibility of quoting different prices based on the funding rates, where based on the funding and the collateral arrangements, the prices that are quoted for the different OTC contracts also differ, which means there is a lot of focus on funding liquidity as an outcome of or as a development of the financial crisis. Then another development that the world has seen post the financial crisis is an integration between the market risk and the credit risk, wherein we see the institutionalization of the CVA in the derivative business, incorporation of the CVA while valuing the OTC derivative contract is a very clear identification where the market and the credit risks are integrated. So calculating the credit value adjustment on a swaps portfolio typically requires the joint modeling of the counterparty's default risk, right? So that's a credit risk. What is the counterparty's default risk? I should be able to model along with the market factors that in case the counterparty is defaulting, how the swap values are going to change, which is a market risk factor. So I need to have a joint modeling between the counterparty's credit default risk along with the market risk, which talks about a fall in the values of the swap, wherein I'm capturing the wrong way risk, which is very much essential for doing the valuation of my OTC derivatives contract. But of course, there is a constraint in terms of the data that I can receive because generally the liquidity is very much limited in the swap spreads to measure the credit risk, especially during the crisis. But what is the more essential aspect is the focus is more towards the integrated look of the market risk as well as the credit risk. Then the next aspect that came out is you have to reduce your dependency on the external credit ratings. During the crisis, it has been very clearly observed that the credit ratings have a lot of shortcomings, especially the credit ratings of the structured products. The rating agencies fail to understand the structure of these products in terms of giving the credit rating. And as an improvement, we could also see that the Dodd-Frank Act that came up in 2010, it clearly highlights and prevents the regulators to use the credit ratings as a part of their regulatory requirement. But of course, still the Basel III is depending on the credit ratings of the credit rating agencies itself, but the need is slowly moving towards all the different market participants themselves taking a greater due diligence in their credit analysis. So that's a change that we will be seeing going forward in future. Then the sovereign risk and new levels have been initiated. Earlier, the notion was sovereign risk was more and more a factor of emerging markets only. Developed markets are hardly impacted by sovereign risk. But that was not the case during the crisis. There was a downgrade on the USA market as well as the European markets as well, economies as well. And the other part is the credit default swaps, which were really perceived as very essential tools in handling the sovereign risk. They have lost much of their effectiveness. So something has to be relooked at. And this is where a challenge comes for different quantitative tools of the risk measurement, where the loopholes will come with the different quantitative tools of the risk measurement, because there has to be a lot of dependence on the political decisions that are taken at the country level. So there is a new way that we need to start looking at the sovereign risk. This is one more improvement that is expected out of the financial crisis. Now, a very important aspect from a quant modeler's perspective, there is a shift from probability to uncertainty. The models, yes, on one side, the models are getting more and more sophisticated where they can estimate the probabilities of losses and rare events. But along with that, something beyond is going on. Imagining the unthinkable. So it's more like an art, it's no more a science. Imagining the unthinkable and developing different stress scenarios based on that imagination of the unthinkable. So the role for uncertainty is really going up, and that particular part of uncertainty which cannot be quantified probabilistically into the risk management, that is the increasing focus that is necessary to be looked at. Then how do I really manage through the regulatory uncertainty? Now it is the phase where there is a regulatory uncertainty going on, because whatever the Basel III regulatory norms that are in place, they will be implemented over a period of time up to 2018. Whatever are the new capital liquidity requirement, so they may undergo different kinds of debates, challenges, etc. So right now there is a level of regulatory uncertainty. So the near-term environment, which is the next couple of years, they will typically have higher levels of regulatory uncertainty. So how are we going to handle that level of uncertainty is one more important challenge that has been posed post the financial crisis. So there are so many developments, improvements that have occurred across the world as an outshoot of learning from the financial crisis. Now that we have understood that aspect, then we'll move on to just understanding how the volatility has been with time, and what are the different implications because of the different volatility regimes that we have observed. This is very much important for us to understand, because this is one interesting aspect where the actions taken at a firm level could be replicated to a system-wide level. So to start with, we'll start from value at risk, which is what we call as the beginning of the modern risk management era, which started off with the value at risk. We know the other definition, it quantifies the risks in a portfolio through a percentile, let's say 99 percentile loss distribution over a day to a 2 week, some period. So it is quantifying the risk in any portfolio, saying 99% value at risk is something. So which will clearly say there is only a 1% chance that the loss will be beyond that particular number during this 1 day or a 2 week kind of a period. So generally the market risk is a short-term focus, whether it is through Basel or through any other tracking mechanisms as well. So tracking the market risk factors to which a portfolio is exposed is one of the major drivers of VAR, major expectations from value at risk, maintaining a historical data on the different market risk factors, how they have been changing over time, taking a stock of every position in the portfolio, and go ahead in terms of calculating a firm-wide value at risk where the aggregation of all the positions across the firm is typically happening. But this has posed a challenge even to the sophisticated financial institutions, and it has been found that the firms which had a very integrated view of their exposures across different institutions, they are the ones who have done well during the financial crisis than those who have looked at a silo-based view of their exposures. So, which means the need for the enterprise risk management really cropped up as an important measure out of the financial crisis. And a few important questions that came out of the VAR calculation. What is that we are trying to measure? And any VAR calculation model has to be calibrated based on the observing exceptions. Right? When I'm saying 99% VAR, it means that one out of the 100 days on an average, I could see an exception occurring, the loss beyond the VAR limit. So in a period of year, there should be at least 2 to 3 such kind of exception. But we have seen some cases where there was no there were literally zero exceptions, and in some cases there were 10 to 15 exceptions. And what could be the reason? So something could not be understood with respect to the calibration of VAR. So in some cases the VAR calculation was looking too conservative, and in some cases it was looking at nowhere close to being conservative. So understanding of the value at risk calculation really went into a soup. What is that loss distribution that we are trying to summarize through the VAR model? Are we looking at a conditional distribution wherein we are talking about conditional on the current market conditions? So depending on the current market condition, will the value at risk levels will change? So are we measuring the VAR that is purely based on conditional conditioned on the current market conditions, or is it completely an unconditional one? When I'm using a mechanism like historical simulation approach, where I have collected the data, let's say over the past 2 to 3 years, and based on that 2 to 3 years data, use the historical simulation to compute the VAR, it means I'm using an unconditional one. I'm not looking at what is the current market scenario today, market position today, condition today. Without looking at it, I'm directly focusing on computation of the VAR, taking the last 2 to 3 years of historical data. This is what is a challenge that came up with the computation of VAR. The volatilities keep changing with time. So depending on the market condition at that particular point, my VAR calculation model should typically change. That is the reason which was failed to be understood by the various banks and financial institutions, and that's the reason VAR could not make a very important inroad. Now, if we are trying to understand the volatility regimes, first of all, if I have to talk about two important universal laws of the market data, first thing I would like to stress upon, the market returns always exhibit high kurtosis. Across the world, we see that the market returns exhibit high kurtosis, which means the fatter tails are going to be existing than the normal distribution with respect to the market return data. And volatility is never constant. It keeps changing with time. It has been observed that the volatility index, there was a 4 to 6 year period where it has been behaving more like this. So this was the trend in the volatility index. Whereas when we looked at the volatility of S&P, it might follow some such kind of a pattern, ups and downs kind of a pattern. So different asset classes are different parameter, different asset classes are following different layers of volatility, but one point is for sure, the volatility is uncertain. And because of even this kind of a movement, the much of the kurtosis that we are seeing is because of the mixing periods of high volatility and low volatility. So I combine a data of high volatility with a data of low volatility, the distribution that is going to get generated is going to be more and more chaotic, highly chaotic. So that is one of the important things we need to understand. So the VAR calculation, when I'm doing purely based on the historical simulation, will get badly affected because I might be using the volatility of the historical data. Probably if I'm trying to compute the VAR here, when the volatility is much lesser, I'm using the last 3 years data where the volatility was much higher to compute the VAR, and that is resulting in a over calculation altogether. Whereas if I am trying to compute the VAR at this period, taking this data as the input when the volatility was literally lesser, probably the output that is coming is nowhere closer to being conservative. I'm entering into the losses in more than the required number of days. So the VAR calibration that is purely based on the historical simulation will get badly affected because of this. And that's the reason we are thinking of going for a regime switching model. We need to really have a regime switching model in place, which will take into consideration the underlying states and the regimes of the economy. So I need to identify different regimes, and within each regime, the different model parameters need to be fixed. But the same parameters across the regimes, they can change. The modeling parameters. So within one regime, I may fix them. But when I'm looking at across the regimes, they should be made volatile. They should be varying. That's one aspect. And there should be a clear mechanism which should be specified for switching from one regime to the other. Right? What should be the model mechanism for switching from one regime to the other? But what is the problem with this? Will definitely give me a good solution. But the limitation of this kind of a model is to really identify a pattern to a different regimes. I need to have a very long historical data. I can't just look at 4 to 5 regime switches and make different kinds of conclusions. I need to have a significantly larger number of regime switches which can really come from a significantly large amount of data. Or alternatively, there could be a dependence on a Garch model, which is also capturing the presence of volatility in the data. But the traditional models of volatility will have their own limitation. That's the reason I have to look at either a regime switching model or a Garch kind of a model. Then, let's assume I'm going with a volatility regime based model. What are the systemic implications of that? When the same risk mitigation, it's a very common thing. If something is a strategy for me, it can give me an advantage. But if all my competitors replicate the same strategy, it's no more an advantage for me. Even the business uses this kind of statement. The same thing I am applying for risk management as well. A risk mitigation step, if it is implemented by a single company, it is very much advantageous to that company. But if it is replicated by multiple firms in the industry, the risk can be amplified instead of being reduced. If many firms are taking similar actions simultaneously because of a change in the volatility regime, whatever the actions they are taking will be completely futile. So we really need to understand that closely related business cycles, they affect all the firms simultaneously. I hope you all agree with this fact. All the firms are impacted in a similar manner because of the closely related business cycles. So once whatever is called as a systematic risk, which is that particular risk that can't be diversified away, will slowly get turned into a systemic risk affecting the operations of the entire financial system itself. Let's take some examples where the amplification of the risk can happen. Look at the regulations that are pro-cyclical. The regulations are taken based on the economic cycle. Just for example, we have seen scenarios where the credit provision during the economic downturn, the constraints get tightened. So I don't get the credit during an economic downturn. So if the credit facilities are not available during an economic downturn, the credit position is even more worsening. The downturn economy is even more worsening because credit is nowhere available. Defaults keep increasing. Even will have a further impact on the economy. When the economy is down, that is the time when loans are typically required. But that is the time the credit provisions also will get tightened. Banks are not coming forward to give loans. So the economy is hampered even more heavier. Similarly, when you talk about the loan loss reserve accounting rules, they capture the declining loss reserves in good terms, and loss reserves keep increasing during the time of economic crisis, because the valuation part, the interest rate that you are using in case of valuing the loss reserves goes down during when the economy is soaring, which will result in a value to be much higher. The fair value accounting rules today talk about using a fair value, not the historical value, for accounting all these things. So the fair value accounting rules are contributing to a downward spiral during the financial distress, because all the values of the assets typically go down. So I'm forced to sell the asset, still reducing the value of the assets on my balance sheet. The prices are going down drastically because the market is not available. There are large number of write downs that are going to happen. So the distress is going to be even more severe because of the accounting rules that are coming into picture. Then the capital requirement during the economic downturn phase, they really want the banks to hold more and more capital. When typically the economy requires more capital, the banks are forced to hold more capital. So all these will even more worsen the system. The risk mitigation strategy that is implemented by firms or individual investors. When the economy is not doing well, that is the time when typically the bank run happens by the depositors. Everyone wants to withdraw their money. So it even impacts the banking system very heavily. When the market is falling, everyone wants to sell off their shares. So it will even further result in further sell-offs, which results in further fall in the market prices and a hurting of the entire economy. We have seen the scenario where many hedge funds were deleveraged with the similar investments. And even the story of AIG, there were a series of repeated collateral calls by all the counterparties of AIG. So that was the time when the cash was draining in the AIG, when the economy was in the downturn. So typically you could see there were hundreds of such incidents which were seen as sources of amplification of the risk when the economy really needed a mitigation for that risk. So that is the kind of a dimension that we need to understand and appreciate. So this kind of a pro-cyclical kind of a nature can be reduced by making the rules less regime sensitive. So I should really look at the rule to be more universal rather than changing the rule, especially during the time of a downturn. An action that would reduce the risk for a single agent, we have to understand that it will definitely amplify when it is undertaken simultaneously by multiple players. So what are the implications for risk management best practices out of the crisis? A quick look at, I have to take a longer term backward look. Just looking at the last 2 to 3 years of the data will not give me a full picture of the financial risk. I have to look at solid 20, 30, 40 years of data to get a complete picture of the financial risk. And we will be able to understand that some important features of financial risk, they emerge only in a time frame of 20 to 30 years, once in 20 to 30 years. So unless we look at a very long data, we can't appreciate the whole world of financial risk, even from the past and even towards the forward. Typically, we see that the value at risk horizon for market risk is just 2 weeks. And for that small time period, we assume that the portfolio composition is fixed and it reflects typically the potential illiquidity in the market. So that needs a change. And of course, as a part of the Basel 2.5, there is a kind of a term that got introduced called the incremental risk charge, where the VAR calculation typically happens over a 1 year horizon, and it is assuming that a rebalancing to a target level of risk is happening, and rebalancing frequency is tied to the asset liquidity there. So because of this, there is some kind of an improvement looking at a longer term forward in terms of computation of the VAR. So the stress testing should go through the different regime changes. I need to have a great focus on different stress scenarios, not just the quantifiable portfolio probabilities alone. So there should be some kind of thinking the unimaginables, and then based on that trying to design my stress scenarios. So not just looking at isolated extreme events, but a continuous periods of increasing volatility across multiple markets. How are they going to really impact? That's one thing our models need to really focus on. And I have to remember the categorical imperative. Every firm really needs to appreciate that any risk mitigation action, when it is taken simultaneously by multiple parties, will really have backfiring on the effectiveness that that particular solution is expected to bring. And pro-cyclicality regulations really have conflicting objectives. Right, on one side, we encourage the regulators encourage the firms to invest in developing precise and sensitive measures of risk, and whatever one good best practice of risk management that comes out, if it is implemented across in a similar manner, it is amplifying the risk. Similar response is taken up by all the financial institutions, then it is amplifying the risk. So what is very much needed is using the unconditional default probabilities, which is the through the cycle default probability, rather than at the point default probability, which is rather than conditional default probability, reduces the pro-cyclicality of the capital. So one more thing that regulators may have to really focus on to address this issue is using the unconditional default probabilities rather than the conditional to reduce the pro-cyclicality of the capital. So these are the things that I really wanted to cover as a part of this wonderful article. So we have really looked at what is the link between a firm focused risk measurement and the systemic concern. What are the risk management lessons and developments that really surface the system after the financial crisis? Just an understanding of the volatility regimes and how did the volatilities change during different periods of time, and how can we really address the computation tools like value at risk to take into consideration the volatility regimes, and what are the implications for the risk management best practices based on this volatility regimes. So thanks a lot for listening to this session. Thank you very much.